Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Just want to quickly go over today's CPI number. So the number just came out about an hour ago. So just to summarize here, we had the core CPI number coming around 0.3%, and the that's the month over month number, and the headline number came in at negative 0.1%, and that's also the month over month number. So in line in terms of the core number month over month, lower than expected in terms of the headline number, which is definitely, when you look at the headline number, that's good news. When you look at the core number, in line is also not bad news. It's not higher than expected, but in line, which is great. Now, if we look at the year over year number, the core year over year CPI number came in at 5.7%, which is also, again, in line. Last month's number was about 6%. And most importantly here, when we look at the CPI headline number year over year, came in around 6.5%, which is in line with the expectations, but also, remember, lower than the last month's number, which came at 7.1%. So not bad in terms of the CPI report. Now, the market reaction in stocks and bonds, well, first let's talk about stocks, was actually both stocks and bonds, gold, everywhere, the initial reaction was a sell-off first. So you had a massive sell-off just because there was so much expectations going into this number that the number was going to be weaker than expected, and especially the core number was going to be lower than expected. However, the number came in line, which kind of shocked the markets initially, right? If you have an expectation that you're going to get, let's say, a Louis Vuitton bag, and you end up not getting a Louis Vuitton bag, but you end up getting maybe the second best or the third best bag out there, then initially you won't be as happy. So it's like the same thing when it comes to the equity market, and how the markets reacted was that, oh, they were expecting this Louis Vuitton kind of figures, but it was okay. It was still not bad. So you had a sell off, and then followed by a pick back up back to the price level one in stocks and bonds. Now, bonds, it did sell off, gold did sell off also, but then afterwards, when it picked up, it started to rally even more, and bonds start to move up, start to take this number kind of in a dovish way. Now, if I look at here right now at the markets, stocks are basically retracing the whole move right now at the 9:30 a.m. open. It's around 10 a.m. right now. But and the bonds also are retracing as well, especially on the long end. So we are shrugging off the data and the news, it looks like right now, because we're still trying to figure out, what does this mean in terms of the Fed. Now, the Fed, obviously, like we know, they're going to continue with its rate hikes. Now, we did have Fed Harker come out today, talk about that he still expects rate hikes in 2023, but just at 25 basis point rate hikes, slower paces, right? Not as high, or what it was like in 2022 when you had the 50 basis point and 75 basis point rate hikes. And not only that, you also have the expectation that a lot of the Fed members will continue with its, especially Powell, with its rate hikes, and not really what the market is anticipating, this pivot that the market's anticipating, not really pivot. And a pivot that the markets keep talking about is this rate cuts. So these rate cuts, I still believe, is long down later in the future. We still need a pause before we start getting into a cut, but I think we will continue at this pace until data or something tells us that we should completely stop, or the Fed should completely stop, right? So let's continue to monitor this. This was not crazy news to be going massively long, in my opinion. Well, now the markets could do whatever it wants to do. It can go long, it can go short, it can sell off. Now we've been going up for past couple of days, so I wouldn't be surprised of some sort of sell off and some profit taking that's happening after the data, because now we're dependent on what is going to come out next, especially from the Fed, especially in the Fed meeting in February. So wait and see what happens there. Now, in the CPI report, I'll link the report in the description for you. If I look at it here, I'll just read it quickly for you. The index for gasoline was far largest contributor to the monthly all items decrease, more than offsetting increases in shelter indexes. So the reason why the headline number came in lower than expected, especially in a negative number, is because you had the gasoline numbers, you had the energy numbers come in weaker than expected, which is not which is as expected. If you're looking at the oil markets, you're looking at the energy markets, you would expect that the headline numbers would come down. So that was offsetting the increases in the shelter indexes. The food index increased by 0.3% over the month, with the food at home rising at 0.2%. The energy index decreased 4.5% over the month as gasoline index declined. Other major energy component indexes increased over the month. The index for all the items less food energy rose 0.3% in December after rising 0.2% in November. Indexes which increase in December include the shelter, household furnishing and operations, motor vehicle insurance, recreation, and apparel indexes. The indexes for used cars, trucks, airline fares were among those that decreased over the month. Okay, so transportation, airlines, they came down, shelter increased, food increased. So all the items increased 6.5% for 12 months ending December. This was the smallest 12-month increase since the period ending October 2021. All items less food energy index rose 5.7%. Over the 12 months, the energy index increased 7.3% for the 12 months ending December, and the food index increased 10.4% over the last year. All the increases were smaller than the 12-month period ending November. So overall, what this report basically says that, okay, we did have the headline numbers come down. We did see gasoline and energy prices come down. However, some components, especially when you look at the core components, there are still certain areas in the core numbers that continue to be elevated. The services, the shelter, the food, they still continue to be higher. There is an increase, and still, these are still things that need to be fought with when it comes to tackling inflation, especially when you look at eggs, right? Eggs have increased quite a bit. If you look in your grocery stores, the prices of eggs have increased. So still, and we heard from the lot of Fed members as well. Powell, we've heard from Harker today saying that they're looking at the real estate market, they're looking at shelter, they're looking at rent. If these numbers continue to be elevated, they will still have to keep at it in terms of hiking rates. So my opinion on all of this is that, okay, not bad report, nothing to go crazily explosive on, nothing to take a major side on, but at the end of the day, the core number is in line. At the end of the day, the shelter prices and the food, it's still showing positive numbers, and we're still at 6.5% in terms of inflation. Yes, we've come down from the peak of 9.1%. It looks like that we are in this trend that inflation is coming down and it's coming lower and lower, and we continue. But remember, the mandate is for the Federal Reserve is 2%. We need to hit 2% in inflation in order to meet the mandate of the Fed. And to get there, you need to keep at it. You need to keep rates at elevated levels. So even if we don't hike more, we will, like the Fed have said, they will pause and they will keep rates higher at elevated levels for longer to bring down inflation. And again, if you do that and you don't cut, then sure, there will definitely be more demand destruction, more growth to deteriorate. And if we continue to increase rates, and if inflation is coming down and they can raise rates above the inflation level and they can successfully do that, like Bullard has talked about with the Taylor rule in one of his presentations, then fantastic, right? Then yes, you can bring the inflation levels down. But remember one thing, even though CPI report is coming down, even though inflation is coming down, you may think that's a very good sign, but that's also another sign as well. What's that other sign? The reason inflation is coming down, CPI is coming down, is because growth is deteriorating, because orders are deteriorating, demand is deteriorating, there's jobs layoffs that are happening. So it's a catch-22, right? Like I've been saying this whole time, in order to bring inflation down, you need to bring the economy into a recession. And it looks like we are in a recession, and due to the recession, yes, the inflation number is coming down. So to bring it down more, continue on with the recession. Go ahead and continue with the recession, and continue with the job layoffs, and continue with the orders and the demand destruction in order for the inflation to come down. And that's what the Fed would like to see. So, two ways of looking at it. You can look at it one way, that great, inflation is coming down, buy stocks, buy equities. The other way you can look at it is that, hey, inflation is coming down. There's a reason it's coming down, is because the recession, because of the growth destruction that's happening. So all in all, if there's more pain to come, more layoffs, unemployment rate to move up higher, more pain, then yeah, that may not be a good thing for the markets, for the economy, and that may throw off the stock market as well. It may rally temporarily on low inflation, but it may catch, the equity markets may catch us, catch themselves off guard, and you might see that, hey, a sell-off later on down the road, especially if numbers continue to deteriorate and really look bad. So let's see what happens, right? There's so many possibilities. People have talked about even certain black swan events, etc., etc. We'll wait and see what happens. But yes, the CPI report does confirm that, inflation is coming down, and inflation is coming down because growth is coming down, because growth and demand is deteriorating. It's as simple as that. Certain areas are still sticky and elevated. Jobs market still looks like it's still doing well. Fed needs to still continue. Doesn't mean that we're going to get the great cut or the pivot that people are expecting. So it is in line with expectation, and it is reflecting with what the growth and data is showing. So anyways, leave a comment below. Let me know what you guys think. Hit the subscribe button, the like button as well, and comment and let me know what you guys think. I'll see you guys around. Cheers. Bye.